Another major benefit is global standardization. The new ISO format uses a single unified standard which simplifies cross-border transactions. Companies can now operate more smoothly across different regions and stay compliant with country-specific regulations. No need to worry about adapting to multiple standards.
Welcome to Actualizing Success. In this podcast series, our in-house advisors discuss today's finance and technology topics with an emphasis on solutions that embrace tomorrow.
Hi, I'm Kerry, COO of Actualize Consulting, and today I am joined by Michelle and Tyler, also part of our Actualize team. Today we will be discussing the Treasury hot topics of 2025 that we are seeing, and those are the use of more technology with artificial intelligence, APIs, the ISO transition, and advanced forecasting. Welcome, Michelle and Tyler.
Thank you.
Thanks, Kerry.
The first topic to discuss is artificial intelligence. At Actualize, we have embraced AI from creating our own bots to help with internal benefits and policies, and one to answer questions on Treasury management system implementations. It's actually really exciting as our bots are getting smarter and smarter by the day because, as many of you know, artificial intelligence is really data-driven. So the more data that you give it, the more good results that you're going to get back. Michelle, what else are you seeing in Treasury from the AI front?
Thanks, Kerry. AI is increasingly transforming the field of Treasury, right from helping the treasurer with strategic planning and scenario analysis to the treasury groups using it to automate and improve daily processes. At a high level, AI provides the treasurer advanced data analysis, predictive modeling, and automation to enhance decision-making and risk management. For strategic planning, AI analyzes historical data, market trends, and internal company metrics to create accurate forecasts and identify potential financial opportunities and challenges. This allows treasurers to align cash management, investment strategies, and capital allocation with long-term business goals. In scenario analysis, AI simulates a wide range of financial scenarios and assesses their impact on cash flow, liquidity, and risk exposure. AI can automate the creation of multiple what-if scenarios, run real-time stress tests, and optimize strategies for managing risk and capital, enabling treasurers to prepare for both expected and unexpected market conditions. Ultimately, AI helps treasurers make more informed, data-driven decisions and improve their ability to plan for uncertainty in an increasingly complex financial environment.
Thanks, Michelle. And data is key for our Treasury teams. Tyler, can you speak to how Treasury groups are using AI for their daily processes?
Yes, Kerry. Let's jump right in with fraud detection, where AI is making a major impact. Treasury teams have always prioritized fraud prevention, but AI is taking it a step further with real-time anomaly detection. Essentially, it learns what normal transactions look like and flags anything unusual right away. This proactive detection allows Treasury teams to catch fraud as it happens, a huge leap beyond traditional tools. And fraud detection is just one side of risk management. AI is also streamlining compliance, especially with Know Your Customer, or KYC, and anti-money laundering, AML checks. With these processes automated, errors are reduced, and teams stay current with evolving regulations, making compliance far more manageable. Now, while AI handles risk and compliance, it also is transforming cash flow forecasting. Treasury teams depend on an accurate forecast, right? And AI-driven algorithms delivered by analyzing not just historical data, but also market trends, interest rates, and even currency shifts. With a sharper view of cash needs, Treasury teams can make better decisions about financing and liquidity, ensuring cash is available exactly when they need it. And AI benefits extend even further into accounts receivable. By studying payment patterns and customer behaviors, AI can actually predict which invoices might be late, which helps teams prioritize collections. It even scores customers based on payment habits, improving credit risk decisions, and reducing days sales outstanding. Keeps cash flowing more predictably. Lastly, there's payments, where AI and RPA, robotic process automation, come together to streamline processes. AI can quickly handle reconciliation and flag discrepancies, which saves time and allows Treasury teams to focus on bigger priorities. AI also optimizes payment routing, choosing the most efficient channels to reduce costs and speed up processing, especially for cross-border payments.
Thanks, Tyler. That's a lot. And thanks, Michelle, on AI. There's definitely a big future to look forward to and seeing how it all transforms in the industry. The next topic is API connectivity, in which a TMS may not be able to connect to other data necessary. The API will connect the systems. Tyler, can you elaborate on some examples of where you're seeing APIs being used in the industry?
Sure, Kerry. To start, APIs are essential for real-time bank connectivity, letting a TMS pull live balances from multiple accounts so Treasury teams always know their exact cash position. This kind of instant visibility really empowers faster and better informed decisions. APIs also integrate a TMS with ERP systems. For instance, by automatically pulling accounts payable and receivable data, Treasury teams can manage cash flows more effectively. Plus, APIs post transactions like FX settlements directly to the ERP's general ledger, ensuring accurate records without manual entries. And in FX trading, APIs connect to TMS platforms like Bloomberg, pulling in current exchange rates and even allowing direct execution of trades. This streamlines FX risk management, keeping everything efficient and up to date. On the payment side, APIs add security by connecting the TMS to fraud detection tools, screening payments automatically for fraud or compliance issues. This helps reduce risk and safeguards the transactions. Finally, API connections, BI tools like Power BI or Tableau allow Treasury teams to analyze liquidity, cash flow, and risk exposure within a centralized platform, enhancing decision-making.
Thanks, Tyler. Again, very riveting on the APIs and Treasury. The third item to discuss is the ISO transition, which I know is hot on people's mind these days. Payments are an enormous part of Treasury management. And with this transition upon us in November of 2025, it made our hot topics list. Michelle, can you let us know what ISO is and what our listeners should be asking themselves as they go into this transition next year?
Sure, Kerry. Very simply, ISO is a universal language for financial transactions. It's a global standard for data exchange that will help banks and other financial institutions communicate with each other. So instead of each bank or country having its own way of sending and receiving messages, ISO provides one common format which can handle more detailed information and make it easier for different systems to understand each other. This standardization will speed up transactions, reduce errors, and make financial processes more efficient. Understanding their readiness and the potential impact on payment processing is crucial for maintaining smooth operations. Treasury groups should ask themselves how the transition affects relationships with banks and payment providers. Are the banks and payment providers ready for the transition? What changes will be made to agreements or communication processes? And how will the transition affect payment speeds, costs, and capabilities?
Thanks, Michelle, for detailing all that with the ISO transition. Tyler, what are the benefits of making this transition?
Yeah, let's begin with data quality. I think one of the biggest benefits of the ISO transition. This standard includes detailed data fields allowing corporations to add rich information like invoice numbers, payment references, and even purpose codes. That level of detail provides clear transaction records, which is a game changer for tracking payment. Another major benefit is global standardization. The new ISO format uses a single unified standard which simplifies cross-border transactions. Companies can now operate more smoothly across different regions and stay compliant with country-specific regulations. No need to worry about adapting to multiple standards. And with this structured, consistent data, automation becomes a lot easier. The new format enables automation in transaction processing, reconciliation, and reporting, which cuts down operational costs and frees up Treasury teams to focus on more strategic tasks. Plus, it supports straight-through processing, which helps avoid delays and reduces payment errors. On the compliance side, the new ISO format also has a lot to offer. With clear data trails, corporations can better meet requirements for anti-money laundering and counterterrorism financing checks, making regulatory reporting easier and more reliable. Future-proofing is another key advantage. The new ISO format is built to adapt, so it can support new data and technologies as they emerge. This adaptability ensures corporations using it now are well prepared for upcoming advancements in the fintech space. And lastly, the standard boosts cash flow visibility, which is crucial for Treasury teams. With detailed transaction information, teams gain better insights into cash inflows and outflows. This makes cash forecasting and working capital management much more accurate and helps optimize liquidity.
Thanks, Tyler. So really, corporations can streamline their operations, enhance compliance, better position themselves within a globally connected financial ecosystem, and they can set a foundation for improved financial management and scalability with this transition. Is that what I'm hearing?
That's right.
All right. Well, the fourth area to discuss is notional pooling and in-house banking. Tyler, what are some of the key considerations and benefits that corporate treasury leaders should be mindful of when considering leveraging a notional cash pooling or in-house banking structure?
Yeah, sure. So look, notional pooling is great for optimizing liquidity without moving funds physically, which allows companies to offset positive and negative balances across subsidiaries. However, there are a few considerations. Regulatory constraints can be a factor, especially in regions with strict cross-border pooling laws, and the interest rate environment also matters, right? So high rates make pooling more valuable, while low rates may reduce the cost savings. Operational complexity is another aspect to think about. Managing different currencies across multiple subsidiaries can get complicated. So companies need the right technology to handle real-time tracking. And of course, choosing a banking partner with strong notional pooling capabilities is essential, since not all banks offer this level of sophistication. But the benefits are compelling. Notional pooling optimizes liquidity, reduces borrowing needs, and helps save on interest costs by offsetting debit and credit balances. It also centralizes FX positions, making currency risk easier to manage, and gives treasury teams enhanced cash visibility to make more strategic decisions. Now, if we shift to in-house banking, which can be incredibly efficient for companies with multiple subsidiaries, setting up an in-house bank requires upfront investment and ongoing maintenance, as well as staying compliant with tax and regulatory requirements, especially for intercompany lending. Subsidiaries also need to align with the in-house banking processes, which can require some internal training. But despite these setup efforts, the advantages are significant. In-house banking reduces reliance on external banks, saving on transaction fees and streamlining intercompany lending and payments. It also provides centralized control, allowing treasury departments to see cash flows organization-wide for more informed decision-making and better compliance.
Great. That's a really good overview. Sometimes I get confused on the difference of those. So kind of summing that up, notional pooling and in-house banking help treasury departments enhance their liquidity, reduce costs, improve control, and manage risk more effectively. Is that right?
That's absolutely right.
And then the benefits are really in managing today's complex global financial environment and making it more efficient with their cash management, risk mitigation, and which are both very crucial to corporate financial stability. Moving on to our last topic, which is forecasting automation. And this is critical in the Treasury landscape because Treasury functions need to be able to forecast to put themselves in the best position possible. What are ways you are seeing automation in the forecasting function?
Let's start with the basics. Forecasting is no longer just about projecting numbers. It's a continuous circular process. Treasury teams now connect seamlessly with banks, accounting systems, and other platforms to consolidate cash forecasts. When real-time data flows in, forecasts update automatically, giving teams instant visibility into their cash positions. By analyzing the differences between forecasts and actuals, they continuously refine their predictions for the future. But how do they handle the grunt work? This is where RPA shines. Repetitive tasks like data entry and reconciliation are now automated. Instead of manually transferring cash positions or gathering input from internal teams, bots handle it all, reducing delays and errors. From there, AI and machine learning take forecasting to the next level. These tools analyze historical data and external trends like customer behavior, seasonality, and market volatility to predict future cash flows with incredible accuracy. They even pull insights from external sources such as market sentiment or economic news to fine-tune forecasts even further. Finally, with accurate forecasts in hand, Treasury teams can act decisively. Whether it's managing cash across currencies or optimizing debt investments, automation ensures funds are where they're needed most, minimizing costs and reducing risks.
Again, thanks, Michelle and Tyler. I think that's all we have time for today. As we wrap up, the topics to watch out for in 2025 for Treasury are artificial intelligence, API connectivity, payments, and the ISO transition, notional pooling, in-house banking, and forecasting automation. Thanks again, and thanks for listening.
Thanks for joining us for today's episode of Actualizing Success. Make sure to visit us online at www.actualizeconsulting.com, where you can explore our service offerings. Don't forget to subscribe to the show on iTunes, Spotify, or your preferred platform. If you've enjoyed what we talked about today, please consider leaving a review and following us on LinkedIn. If you have any questions or would like to share your opinions with us, please send us a note at podcast@actualizeconsulting.com. We look forward to hearing from you.